Most traders believe their success will come from knowing what happens next. They wake up every day asking the same silent question, where is the market going? And in that question lies the root of their struggle. The market does not reward prediction. It never has. It never will. Yet traders continue to exhaust their energy trying to forecast outcomes in an environment designed to remain uncertain. The turning point in a trader's journey arrives the moment they stop demanding certainty from the market and start allowing the market to reveal itself. This is where patience becomes more powerful than intelligence, more profitable than speed, and more reliable than confidence. Patience is not waiting without purpose, it is waiting with alignment. It is the ability to remain mentally neutral until the market confirms, rather than acting to relieve emotional discomfort. When you understand that the market is an unfolding process, not a puzzle to be solved, everything changes. You stop forcing trades. You stop needing to be right. You stop confusing activity with progress, and in that space, clarity emerges. The market always communicates, but only to those who are patient enough to listen instead of predict. Most traders are not losing money because they lack information. They are losing money because they cannot tolerate uncertainty. The human mind is wired to seek closure, certainty, and control, but the market operates on probability, randomness, and incomplete information. The conflict between these two realities is where most pain originates. Prediction feels productive. It gives the illusion of control. When a trader predicts, they feel involved, intelligent, and prepared. But prediction quietly shifts the trader's focus away from the only thing that actually matters, what the market is doing now. The moment you predict, you form an emotional attachment to an outcome, and once attachment exists, objectivity disappears. Patience, on the other hand, requires emotional maturity. It demands that you sit in uncertainty without acting impulsively. It asks you to accept that you do not need to know what will happen next in order to make money. This idea alone is deeply uncomfortable for most traders because it contradicts how they were taught to think. The market does not move to fulfill your expectations. It moves according to collective behavior, liquidity, and evolving information. When you predict, you are placing yourself in opposition to this reality. You are asking the market to confirm your belief instead of observing what it is already communicating. This is why prediction creates frustration, while patience creates alignment. Patience is not passive. It is an active mental state. It is the discipline of waiting for information to become obvious rather than forcing meaning onto incomplete data. When you are patient, you are not guessing, you are responding. And response is always more accurate than anticipation. Most traders enter trades because they feel something: fear of missing out, fear of being wrong, excitement, boredom, or the need to recover a loss. None of these emotions are connected to market structure. They are internal pressures looking for release. Prediction gives these emotions a justification. Patience removes their power. When you wait, something remarkable happens. The noise begins to fade. You start noticing repetition instead of randomness. You see how price behaves when it is accepted, and how it behaves when it is rejected. You begin to recognize that the market reveals its intentions through behavior, not through predictions. The market speaks in probabilities, not promises. Patience allows you to hear that language. Impatience translates probability into certainty, and certainty does not exist here. The trader who waits does not need to be right. They only need to be consistent. They understand that any single trade is irrelevant in the larger distribution of outcomes. This understanding dissolves fear. When fear dissolves, clarity emerges, and clarity leads to disciplined execution. Prediction narrows perception. Patience expands it. When you predict, you see only what supports your belief. When you are patient, you see what is actually happening. This difference determines whether you react emotionally or act deliberately. The market is always revealing itself, but not on your timeline. It reveals itself through confirmation, through follow-through, through failure, and through continuation. The patient trader waits for these clues. They do not rush to label the market. They allow it to demonstrate its intent. This is why patience outperforms prediction. Prediction is static. It assumes the future is fixed. Patience is adaptive. It responds to what unfolds. The market is dynamic. Only an adaptive mindset can survive in it. The moment you stop asking, where is price going, and start asking, what is price doing right now? Your relationship with the market changes. You no longer feel betrayed when a trade fails, because failure was always part of the probability. You no longer chase opportunities, because you trust that they will appear again. Patience also removes the need for validation. You stop measuring yourself by wins and losses. Instead, you measure yourself by execution quality. Did you wait for confirmation? Did you follow your rules? Did you accept the outcome without emotional reaction? These questions create consistency. Prediction never will. The market does not reward effort, it rewards alignment. And alignment comes from observing, not forecasting. When you are patient, you give the market permission to be what it is. You stop trying to impose meaning on every movement. You stop fighting randomness. And in doing so, you stop fighting yourself. This is where confidence is born, not from being right, but from knowing that you can remain disciplined regardless of outcome. That confidence cannot be shaken by a loss because it was never dependent on certainty in the first place. The trader who understands patience understands freedom. Freedom from emotional urgency. Freedom from the need to control. Freedom from the illusion that success requires prediction. Prediction is comforting. It gives the mind something to hold on to in an environment where nothing is guaranteed. When a trader predicts, they are not seeking accuracy. They are seeking relief. Relief from uncertainty, relief from doubt, relief from the emotional discomfort that naturally arises when money is at risk and outcomes are unknown. This is why prediction feels necessary, even when experience repeatedly proves it unreliable. The need to predict does not come from the market. It comes from within. It is rooted in the belief that knowing what will happen next is the same as being prepared. But preparation in trading has nothing to do with foreseeing outcomes. Preparation is about readiness to respond, not readiness to be right. The moment a trader confuses these two, prediction becomes an emotional crutch. A crutch exists to support weakness, not strength. When traders lean on prediction, they are compensating for an inability to accept uncertainty. They believe that if they can just figure out where price is going, fear will disappear. But fear does not disappear through prediction. It intensifies. The more convinced a trader becomes about a future outcome, the more emotionally exposed they are when the market behaves differently. Prediction narrows perception. Once the mind commits to a belief about what should happen, it begins filtering information. Evidence that supports the prediction feels reassuring. Evidence that contradicts it feels threatening. This selective perception is not a flaw in intelligence. It is a natural human survival mechanism. But in trading, this mechanism works against consistency. The market is not obligated to confirm your expectations. It is not aware of your analysis, your logic, or your confidence. It simply reflects collective behavior in real time. When a trader predicts, they unknowingly enter into a psychological negotiation with the market. I will feel calm if you do what I expect. The market never agrees to this contract. This is why prediction creates emotional instability. When price moves slightly against a prediction, anxiety begins. When it moves further, fear intensifies. When it invalidates the prediction completely, frustration or anger follows. None of these emotional reactions are caused by the loss itself. They are caused by the violation of expectation. An edge does not require expectation. An edge operates independently of outcome. It exists within a framework of probabilities, not certainties. Prediction tries to earn probability into certainty. In doing so, it destroys the very neutrality required to execute an edge consistently. Many traders believe they are trading a system, but emotionally, they are trading their predictions. They enter a trade because it should work. They hold because it must turn. They exit early because it looks wrong. Every decision becomes reactive, not because the system failed, but because prediction hijacked perception. The irony is that prediction feels analytical, but it is emotional at its core. It is driven by the need to avoid discomfort, not by an understanding of probability. The mind prefers a wrong answer over no answer at all. In trading, this preference is costly. When a trader lets go of prediction, something profound happens. The pressure to be right disappears. Without that pressure, the mind becomes open to seeing what is actually happening instead of what it wants to happen, open to accepting losses without internal conflict, open to following rules without internal negotiation. This openness is where consistency lives. Consistency is not a product of superior forecasting. It is the result of emotional alignment with uncertainty. A trader who accepts that they do not know what will happen next has no reason to argue with the market. They simply observe and respond. Prediction creates attachment. Attachment creates fear. Fear creates hesitation, impulsiveness, and rule-breaking. This chain reaction happens so subtly that most traders never recognize prediction as the source. They blame strategy, timing, or discipline, while continuing to lean on the same emotional crutch. The market does not reward certainty-seeking behavior. It rewards those who can operate without emotional dependency on outcomes. The trader who needs to predict is emotionally dependent. The trader who waits for confirmation is emotionally independent. An edge expresses itself over a series of trades, not a single one. Prediction focuses on the single outcome. Patience focuses on the distribution. This difference determines whether a trader experiences the market as threatening or neutral. When you predict, every trade feels significant. Your self-worth becomes entangled with the result. When you operate probabilistically, each trade is just one event in a long sequence. Significance dissolves. Emotional charge fades. Execution improves. The desire to predict also distorts time perception. Traders feel rushed. They believe that if they don't act now, opportunity will disappear. This urgency has nothing to do with market structure. It comes from emotional attachment to imagined futures. The market offers endless opportunities, but prediction convinces the mind that this one moment is special. Without prediction, patience becomes natural. There is no rush to act because there is no need to prove anything. There is no fear of missing out because nothing is being chased. The trader waits for the market to reveal information instead of forcing meaning onto incomplete data. Prediction says, I know. Patience says, I observe. One creates tension, the other creates clarity. The most dangerous aspect of prediction is not that it is wrong, it is that it feels right. It feels intelligent, it feels proactive, it feels responsible. But feeling right is not the same as trading well. Trading well requires emotional neutrality, not emotional reassurance. The market constantly changes. Volatility expands and contracts. Conditions shift. Behavior evolves. Prediction freezes the mind in a static belief while the environment remains dynamic. This mismatch creates confusion and self-doubt. Letting go of prediction does not mean abandoning analysis. It means using analysis to define conditions, not outcomes. Conditions can be observed and measured. Outcomes cannot. This distinction is critical. When a trader stops predicting, losses stop feeling personal, wins stop feeling validating, both become data. This emotional flattening is not difference, it is professionalism. It is the mental state required to operate in probabilities without psychological interference. The edge was never in knowing what would happen next. The edge was always in responding appropriately when something happened. Prediction distracts from response. Patience enhances it. The market reveals itself through behavior, not forecasts. It shows acceptance, rejection, continuation, and failure. These signals are only visible to a mind that is not committed to a story about the future. When you no longer need the market to confirm your beliefs, you are free. Free to exit without regret. Free to enter without hesitation. Free to follow your plan without internal conflict. Prediction is an emotional crutch because it props up the illusion of control. But control was never available. Acceptance is, and once a trader fully accepts that uncertainty is not a problem to be solved, but a condition to be embraced, prediction naturally loses its grip. What remains is clarity, patience, and consistency, qualities that were never found in forecasting, only in understanding the nature of the game. Patience is often misunderstood in trading. Most people believe patience means waiting longer, doing less, or suppressing the urge to act. But patience has nothing to do with time. It has everything to do with alignment. True patience aligns the trader with probability, while impatience aligns the trader with hope. And hope has no place in an environment governed by uncertainty. Hope emerges when a trader wants something to happen without evidence that it is happening. Probability emerges when a trader accepts that outcomes are unknown and focuses instead on likelihood over a series of events. These two mental states cannot coexist. The moment hope enters the decision-making process, probability is abandoned. The market does not reward what you want. It rewards how well you align with what is statistically possible. Patience is the bridge between uncertainty and consistency because it allows probability to unfold without emotional interference. Without patience, the trader attempts to force outcomes. With patience, the trader allows outcomes to reveal themselves. Most traders act too early, not because opportunity is present, but because emotional discomfort is present. Waiting feels unbearable when the mind demands certainty. Acting feels like relief. That relief is often mistaken for confidence, but it is actually the release of tension. This is how hope disguises itself as decisiveness. Patience removes the need for relief. When a trader accepts that not knowing is normal, waiting no longer feels like punishment. It becomes observation. Observation creates information. Information creates clarity. Clarity allows probability to express itself. Hope is personal. Probability is impersonal. Hope says, this trade needs to work. Probability says, this trade doesn't matter. That difference changes everything. When a trade doesn't matter, fear disappears. When fear disappears, execution becomes effortless. A probabilistic mindset understands that any single outcome is irrelevant. What matters is how faithfully the trader executes a process over time. Patience protects that process. It prevents premature entries, emotional exits, and reactive decisions. It keeps the trader aligned with what statistically works rather than what emotionally feels right. The market offers endless information, but it reveals it gradually. Impatient traders attempt to extract conclusions from incomplete data. Patient traders allow confirmation to appear. Confirmation is not certainty, it is alignment. It is the moment when probability begins to favor one side over the other. Hope thrives in ambiguity. The less information available, the more room hope has to grow. Patience reduces ambiguity by waiting for the market to communicate. This communication does not come through prediction, but through behavior. Behavior reveals acceptance, rejection, continuation, or failure. These are not guesses. They are observable facts. Many traders confuse patience with hesitation. Hesitation is fear-based. Patience is clarity-based. Hesitation occurs when a trader wants to act but is afraid of being wrong. Patience occurs when a trader knows that acting now does not align with probability. One creates anxiety, the other creates confidence. Confidence in trading does not come from certainty. It comes from trust in a process that works over time. That trust cannot exist without patience. Without patience, every trade becomes a test of self-worth. With patience, every trade becomes just another data point. Hope attaches meaning to outcomes. Probability removes meaning. This emotional neutrality is essential. The moment a trader hopes, they are emotionally invested. Emotional investment distorts perception. Distorted perception leads to poor execution. Poor execution leads to inconsistency. Patience allows the trader to remain mentally flat, not excited, not fearful, just present. In this state, decisions are clean, entries are deliberate, exits are respected, losses are accepted, wins are not chased. This emotional balance is not accidental. It is the direct result of aligning with probability instead of hope. The impatient trader is always early or late. Early because they anticipate, late because they hesitate, after being wrong. The patient trader moves with the market, not ahead of it and not behind it. This synchronization is where probability becomes visible. Probability does not announce itself loudly. It whispers through repetition, through similar setups behaving similarly over time. Patience is required to notice these patterns because they do not appear in single moments. They emerge across many. Hope demands immediacy. Probability rewards consistency. Hope asks, will this trade work? Probability asks, does this trade fit the model? The first question creates anxiety. The second creates discipline. When a trader operates from hope, losses feel unfair. When a trader operates from probability, losses feel expected. Expected losses do not create emotional damage. Unexpected losses do. Patience transforms losses from personal failures into statistical necessities. Most traders intellectually understand probability, but emotionally reject it. Patience is the emotional acceptance of probability. It is the willingness to let outcomes vary without internal resistance. This acceptance cannot be forced. It develops through conscious restraint and repeated observation. The market is neutral. It does not favor patience or punish impatience. It simply reflects behavior. But probability favors those who wait for alignment rather than those who demand certainty. The trader who waits allows probability to tilt naturally. The trader who hopes attempts to tilt it emotionally. Patience also protects the trader from overtrading. Overtrading is not a lack of discipline. It is an abundance of hope. Hope that more trades will produce better results. Hope that activity equals progress. Probability does not care about activity. It cares about quality and repetition. When patience becomes a habit, the trader stops searching for excitement. They stop needing constant engagement. The market becomes quieter, not because it changed, but because the trader's mind did. In that quiet, structure becomes obvious. Probability requires distance. Distance from outcome. Distance from ego. Distance from fear. Patience creates that distance. Without it, the trader is too close to every fluctuation, reacting instead of responding. The greatest paradox in trading is that doing less often produces more. Less forcing, less predicting, less hoping, more waiting, more observing, more aligning. This is not laziness, it is precision. Hope wants resolution. Probability accepts ambiguity. The trader who accepts ambiguity is free, free from the need to control, free from emotional urgency, free to execute without internal conflict. Patience is not something you apply once you are confident. It is what creates confidence. Confidence built on patience is unshakable because it does not depend on outcome. It depends on behavior. The market will always remain uncertain. That is not a flaw. It is the very condition that makes opportunity possible. Patience allows the trader to coexist with this uncertainty without emotional friction. Hope cannot. In the end, patience is not about waiting for the right moment. It is about being the right mindset when the moment arrives. And when that mindset is aligned with probability instead of hope, consistency is no longer something you chase. It becomes something you experience naturally. The market does not respond to what you think will happen. It responds to what participants are actually doing in real time. This distinction is subtle, but it defines the difference between anticipation and observation. Anticipation is forward-focused and emotionally charged. Observation is present-focused and neutral. One is rooted in imagination. The other is rooted in evidence. The market consistently rewards the latter. Most traders believe they are observing when, in reality, they are anticipating. They look at price and immediate tell. Why project a future outcome? Their eyes are on the chart, but their mind is in the future. This mental shift happens automatically, and once it happens, perception becomes distorted. Instead of seeing what is unfolding, the trader sees what they expect to unfold. Anticipation feels proactive. It creates a sense of intelligence and preparedness. But anticipation is not awareness, it is assumption. The moment you assume, you stop listening. And when you stop listening, you miss what the market is actually communicating. Observation requires patience and humility. It requires the willingness to accept that the market does not owe you clarity on demand. Observation means allowing price to express acceptance, rejection, hesitation, or continuation before forming a conclusion. These behaviors are not predictions, they are facts revealed through interaction. The market communicates through behavior, not intention. It does not announce reversals or continuations, it demonstrates them. Anticipation tries to interpret intention before behavior confirms it. Observation waits for behavior to provide evidence. When traders anticipate, they enter early. They justify it by saying they want a better price. But what they are actually doing is acting before probability has shifted. Early entries are not signs of skill. They are signs of emotional urgency. Urgency always comes from anticipation. Observation removes urgency. When a trader is observing, there is no rush. The market will do what it does, whether the trader participates or not. This understanding creates emotional distance. Emotional distance restores objectivity. The anticipatory trader feels constantly pressured. Every movement seems significant. Every pause feels like a missed opportunity. This pressure is not coming from the market. It is coming from the trader's internal narrative about what should happen next. Observe. Patience quiets that narrative. When you observe, you notice rhythm instead of noise. You see how price behaves when it reaches certain areas. You notice whether it accelerates, stalls, or rejects. These observations are not dramatic, but they are reliable. Reliability is more valuable than excitement. Anticipation is future-oriented, which makes every trade personal. If the future does not unfold as expected, disappointment follows. Observation is present-oriented, which makes every trade informational. If something does not work, it simply adds data. The market does not reward those who guess right. It rewards those who manage risk well and stay aligned with behavior. You can anticipate correctly and still lose money if execution is flawed. You can observe accurately and remain profitable even when outcomes vary. Observation allows the trader to respond instead of react. Reaction is emotional and immediate. Response is deliberate and informed. The difference lies in whether the trader was anticipating or observing at the moment of decision. Most mistakes in trading happen not because the trader did not know enough, but because they acted before the market finished speaking. Observation requires waiting for completion. Anticipation interrupts the conversation. When a trader anticipates, they attach meaning to partial information. A single candle becomes a signal. A minor pullback becomes a reversal. A pause becomes confirmation. These interpretations are emotionally convenient but statistically weak. Observation respects sequence. It understands that behavior unfolds over time. It waits for follow-through. It waits for failure to fail. It waits for strength to prove itself. This waiting is not passive, it is attentive. The market constantly tests patience. It lures traders into anticipation by moving just enough to trigger emotion, but not enough to confirm dire. Those who anticipate are pulled in repeatedly. Those who observe remain detached. Detachment does not mean disinterest. It means clarity without attachment. The observer cares about process, not outcome. The anticipator cares about outcome, not process. One leads to consistency. The other leads to frustration. Anticipation is rooted in fear of missing out. Observation is rooted in trust that opportunity is abundant. When a trader trusts abundance, there is no need to rush. When they fear scarcity, anticipation takes over. The market is never early or late. It moves when it moves. Anticipation tries to align the market with personal timing. Observation aligns the trader with market timing. Only one of these is possible. When you observe, you begin to notice how often anticipation would have been wrong. You see how many trades would have failed if entered early. This realization is humbling but freeing. It shifts respect from opinion to evidence. Observation also changes how losses are experienced. Losses no longer feel like betrayals because there was no assumption to violate. They are simply outcomes within a probabilistic framework. Emotional recovery becomes immediate. The trader who observes understands that confirmation is not perfection. It is simply the point at which probability becomes favorable. Waiting for that point means missing some moves. That is not a flaw. It is the cost of consistency. Anticipation promises more opportunity. Observation delivers fewer but higher quality opportunities. Over time, quality outperforms quantity in every probabilistic environment. The market reveals itself through repetition, not prediction. The same behaviors appear again and again. Only an observer can see them because they require attention without expectation. When observation becomes habitual, the trader stops trying to outsmart the market. They stop arguing with price. They stop forcing trades. Trading becomes quieter, slower, and more deliberate. This is where confidence stabilizes, not because the trader feels certain, but because they feel aligned. Alignment removes internal conflict. Without conflict, execution becomes clean. The market does not care how intelligent your analysis is. It responds only to participation and behavior. Observation aligns you with that behavior. Anticipation pulls you away from it. In the end, the market rewards those who listen before they speak, watch before they act, and wait before they decide. Observation is not passive. It is the highest form of engagement. And in an environment built on uncertainty, it is the only position that consistently pays. The market never required prediction, speed, or certainty. It only required awareness. When you stop anticipating and start observing, you align with how the market actually moves instead of how you want it to move. Patience keeps you grounded in probability. Observation keeps you connected to reality, and consistency becomes a natural result. The market always reveals itself, but only to those who are willing to wait, watch, and respond without emotional interference.